Hello again. This is Mike, your legacy wealth coach, here today to see how we can be using IBC for car purchases. Now, this is a case study. We're going to be walking through real life example for financing need that most of us actually have many times throughout our lives. So this is a very familiar um, topic for most, and we can see how IBC can work for you. Now, the first thing we'll look at is the conventional thinking. Most of us know that there are different ways that you can buy a car. You can lease a car where you basically just rent the use of the car. You do not own it, never will. At the end of the term, you have no car, no cash. You could borrow the car. Well, not the car. You borrow the money for the car with a car note with the financing department of the dealer or with the bank. And that's on the bottom. You can see that loan method with the red arrow. You drop in the money for the loan, and you slowly pay it back to the 0 point at which you're finished paying off the car, and at least you have the car. You can also save up with cash to, buy the car outright, but that takes time. And you can see on the top triangle, saving up to that peak where you have enough to pay all the cash. Again, you end up with a car, but with no cash at the end. You either pay interest or give up interest you could have earned in these conventional methods. Now, taking a closer look at how it works with the $0 line at the top, you see when you take out loans, for example, the first purchase is a car. You take the car loan out for $20,000. You're immediately in the hole for $20,000. The graduated step up represents your payments monthly back against the car loan until you finally owe nothing. You have the car outright. Then, of course, you have other purchases like a house or a condo. You see there, you drop down. You're now again at negative $200,000 that you owe, and you have to slowly pay your way back to zero. Continue on for education, for vacation expenses, whatever it is. But typically, that's how taking out loans affects your savings, AKA you have none. You can also, of course, save up, and this is what's considered usually the more prudent way because you avoid paying that interest that you also have to pay when you take loans out. Paying for cash, let's see what that looks like. Here, if you buy a car, you gotta slowly, eventually put money away month to month to month until you have the $20,000 to pay for the car. Then, of course, once you have that money, boom, you're back to zero. You drain your account to buy the car. Same thing with a home, same thing with education, whether it's a 529 plan or a savings plan, vacations, any types of, repairs, home repairs. If you pay cash, the one advantage is you avoid paying interest, but you do have that time lag for saving up to make that purchase. Again, the net result's the same. You end up at the zero line, losing all the money that you had to pay to purchase that thing. Now, let's look at a third way that most people don't know. This is the IBC way, infinite banking concept. In essence, this is simply setting up your policy. Okay, you take some time to capitalize it, and then the policy continues to grow. Okay, everyone understands that with it. Cash values increasing, death benefits increasing. What you do, however, is you borrow against the policy. Now, I say borrow against versus withdraw from. That's a big difference. When you borrow against it, it's collateralized. Your loans to yourself or from your own bank are collateralized by the cash values of your policy. So you see with the car purchase, boom, maybe that's the 20,000. You pay yourself back up. For college, boom, pay yourself back, boom, pay yourself back, on and on and on. However, you see the red squares is where you end up each time. And note, it is well above the zero line here. In essence, although you're using the money just as you were before and paying interest just as you were before, that interest and money goes back to your policy. And every time it is a positive net result that you're building savings as you use the money that you need to in life to finance everything, okay? So let's look at how this works specifically. But before then, let's cover the wealth building principles that IBC requires or focuses on. This book here, Becoming Your Own Banker by Nelson Nash, is really, you know, the seminal piece that really kind of explains his discovery of the IBC, you know, and the concepts are to first pay yourself rather than others is, you know, what it doesn't say. The second is to recapture your lost dollars, okay? Lost dollars go out to interest, taxes, whatever. And the third is to charge interest for the use of your own dollars, just as you would outside with a commercial loan at a bank or a, you know, the auto financing company, but charge interest and be an honest banker for your own money usage. All right. Now let's look specifically. This is a policy illustration that's geared for IBC purposes. And our subject is a male, healthy male, 35 years of age. His premium deposit annually is $4,000. There's also a cash boost PUA, it's paid up additions, cash boost of $6,000. This is temporary for the first 4 years, and $100 minimum after year 5 that continues on. The interest rate of return, if you're interested, is 4.76. But what this does is this 4,000 plus 6,000 shows up here on the premium deposits, okay? And you can see he capitalizes that here. And then the car purchase details we're gonna use is $20,000 at a time. Okay, we're gonna go over 5 examples of this in his lifetime. 5-year term, 7.5, about 7.5% interest that he charges himself and pays himself back, remember. Comes out to a nice round number of $400 a month, annual payments of $4,800 a year. All right, so we just want to lay down these assumptions that we're going to be using for this illustration and for his lifetime. Specifically, let's look at the first car purchase. Remember, he pays himself first by investing into his own system or capitalizing that system for 4 years. All right, that's shown up here in number 1. Year 1 dumps in the 4 plus 6 is the 10,000. Year 2, 10,000. Year 3, 10,000. Year 4, 10,000. Now, after that, well, while he does that, he recaptures the lost dollars, okay, as interest that comes back to him in a tax-favored system. That's in this column here, the cash value. Remember, column 1's what he put into it. Now, column 2 is the cash value as it builds in his system, in his policy. All right. Number 3, this column, the annual car loan repayments, he pays himself interest on his own dollars. Okay, so what did he do in year 4? Well, he put in $40,000, and actually by year 3, he already has $23,000 available. So in year 4, he pulls out, well, he makes a loan out of his policy of $20,000. He pays himself back this loan, $4,800 a year for 5 years, okay? We're just setting up the purchase. In year 8, he pays a total of $8,900, okay? That is at year 8, you see, it's the $4,100 for the base, the premium, plus the $4,800 car payment back to his policy for a total of $8,900, all right? But what do you notice? In the same year, in year 8, his cash value difference has grown by $10,064. So by year 8, he put in just under $9,000 and he got over $10,000 of growth. Pretty good. Now let's continue at year 9, okay? He takes the trade-in value of his old car and decides, oh, I want a newer car, okay, or a better car. So he takes the trade-in value of that car, maybe it's about $8,000 by then, who knows, plus another $20,000 that he withdraws to purchase the other car, the second car. Again, he pulls out the 20, pays back the $4,800 per year for 5 years. By year 13, he deposits the same $8,900. Remember, and his cash values now, however, have increased by another $12,000. See the difference here? 78,894 and 90,918. So he put in again 9,000 and he got now 12,000. What is happening? By borrowing against his policy, his money continues to grow uninterrupted with compounding growth. These policies get better every year. They become more and more efficient with the same dollars. All right, now let's jump ahead. At age 63, he makes his last car payment back to himself in year 28 of $4,800. Now, here on out, he no longer makes these payments. So every year after, he only makes $4,100 of base premium payment. But by age 65, you notice his cash value has grown by $15,465. After putting in $4,100, he gets about $15,500 of growth. Also by age 65, please note that his total deposit into this system was $166,600. And this total investment includes all of his insurance premium deposits, plus his repayments for the cars, minus the actual money he pulled out to purchase the cars. Okay, so we put in $166,600. However, note that his net cash value at this point is $288,118. Bonus, when he does pass on, he will leave behind a tax-free death benefit of over $600,000. Think about this. How fast does 20 or 30 years go by, really, in a lifetime? Could he have done this with his wife's car and doubled the numbers? Absolutely. Could he be the banker for his kids and grandkids' cars? For sure. Interest, remember, payments all stay in the family to continue that cycling growth. And how many cars have you bought already? Think about that. Would you be in a better position today had you practiced IBC when you bought your first car? If these questions interest you, you'd like to learn more, please check out our websites and books. The book before I mentioned was Infinite Banking Concept by Nelson Nash. Two websites I recommend you check out is lifesuccesslegacy.com, where you'll find a host of information and people that can help you. And also my Facebook page, Legacy Wealth Coach. Contact me also if you'd like a free transcript and see how this can work with your own numbers at legacywealthcoach@gmail.com. Thanks for stopping by and listening. Hope you learned something, and I'll talk to you soon.